What's up, everyone? It's Karthik with MoneyVest. So we are going to continue in our understanding of volatility. So I did a video on volatility and trying to help you understand contango and backwardation in one of my previous videos. I highly recommend you go back and understand the basics, what volatility really is, what is the VIX, how it's calculated, what it represents, the VIX cheat sheet, the fair value of the VIX. Everything was discussed in a previous video. But in this video, I want to take it a little bit step further and really help you understand how to identify proper reversals in the markets using volatility. So the keyword here is using volatility metrics, and we're not looking at technical metrics or technical market breadth or the MoneyVest index, for example. We're not focusing on that. So what I do here at MoneyVest is a combination of all these metrics to better understand when there are market bottoms, or really when the reversal opportunities are the highest and the risk reward are the most favorable. At the end of the day, really nobody knows when the markets are going to bottom out or top out, but it gives us a bit of a sense and some idea of what ranges are very important for us to look at and where the risk reward is extremely important for traders and for investors. So hope you all enjoy this video. All I'm asking in return is that you drop a like and share this video with one other person, whether it's a family member, friend, trader, investor who can benefit from this information. These are pretty academic discussions because this involves a lot of math and statistics, but I really try to simplify these concepts down so that you can understand it and use it really well. And again, make confident, more informed decisions when it comes to the market. So what we talked about in our previous video is really helping you understand what volatility is, how it's calculated, and what it represents. This is the cheat sheet. I also mentioned that the markets, since it was only down 9% from its all-time highs, we did see a overreaction on volatility, right? So VIX, which was the volatility index, which we like to look at, which tells us the one-year expected move on the S&P 500 shot up to as much as 65, right? So that was a quite significant level. And based on this volatility value of 62 to 74, somewhere between those two values, the S&P 500's 1 month implied move should have been somewhere between 17 and 21%. But we were nowhere near close to a bear market. We were only down over 8.5, close to 9%. So based on that drawdown on the S&P 500, an appropriate VIX value should have been closer to 30. And we were trading all the way as much as 65. So we were twice as high as what the appropriate value should be. Soon enough, we saw the volatility crush back down. And right now, as of the time of this video, if you come over to our trading view, you'll notice that volatility at the moment is trading at 27.85. So we're back down to under 28. And we're somewhere between 25 and 30, which again, as you can see, the 25 to 30 is going to put us somewhere between 7 to almost 9% down from all-time highs. And guess what? That's exactly what the S&P 500 is doing at the moment. So you'll notice that we are exactly from all-time highs down a little bit over 8.5%. So now everything is back to normal and appropriate. Now, in order for us to understand when these market sell-offs actually begin and when these market reversals will take place, we need to understand what's called contango or backwardation. That's exactly what I discussed in my previous video. So contango is nothing but a very normal functioning market. And that is to say, so there's contracts, right? So there's obviously volatility contracts for the next several months out, 30 days, 60 days, 90 days, 120 days. And what we're really trying to understand is that if you come over to my spreadsheet, so this right here are the 5 different VIX future contracts. We've got the 9-day futures contract for volatility. We've got the 30-day, which is the normal volatility, which we look at on the channel. We've got the 3-month, the 6-month, and 1-year contract. So this right here, if you plot all the values on a line chart, what you'll see is a line, right? So line chart. So this is what a contango market looks like, because now we're seeing the longer dated volatility futures priced higher than shorter dated volatility futures. That is a normal, stable, and properly functioning market, which is the contango should be upward sloping. And again, that's what we're seeing, or that's at least what we saw back on July 16th when the markets were trading at all-time highs. This right here is the current market structure for volatility as of 8/8. So today, August 8th, is when I'm recording this video. So this is what it looks like as of right now. So you'll notice that this is now downward sloping because there's elevated fear, and this is what's called backwardation. Now, there are instances where you can either get a full contango, which is something like this, where all the future contracts are priced higher than the previous one, or you can have certain contracts priced higher than other ones, and then the rest of the curve can be in contango or backwardation. So it can really be a combination of contango and backwardation. It's not like something is in full contango or full backwardation, right? That happens. Full contango can be in a normal functioning market, something that we witnessed back on July 16. So let me see if I have the chart. So this is the VIX terms future term structure right now as of yesterday. But usually what you'll see is a normal specific line sloping upwards. That is a contango, is a normal functioning market. Now, if it's downward sloping, something that we have witnessed before, and right now you'll notice that September and October contract are in contango because the October contract, which is a little bit farther out, is priced higher than the September contract. But then post-October, we are back into backwardation where volatility is expected to come down and October contract is priced higher than November and November is priced higher than December, and they're moving back into contango post-December. So this right here is we've got backwardation, contango, backwardation, and then contango towards the end of the back half of the contracts for volatility as well. But really what we look at for investors, and it's going to give us a bit of a sense of what the short-term to medium-term volatility looks like, is the first two contracts. It's really just the first two contracts that we look at. And in this case, we're looking at the 9-day volatility on the VIX here, VIX futures, and the 30-day volatility. So we're looking at VIX 90 and the VIX 30D or VIX regular one to better understand where the contango or the backwardation status is. So right now, as it stands, August 8th, you've got volatility at a 90 priced at 29.26. And the 30-day, which is the normal VIX, is priced at 27.88. So right now you'll notice that the 90, the shorter term volatility, is higher than the 30-day volatility. So that is still in backwardation, right? So meaning that we've got a longer dated option for longer dated VIX future priced higher than a shorter dated VIX future. So that's the backwardation that we're seeing. So what we like to look at is the difference between this backwardation. So what we can do, we can actually calculate that for ourselves. So all we have to do is essentially, it's going to be the M2 minus M1. So that's going to give you the actual number, right? So number as in minus 1.38 is the difference of this backwardation. But you can also calculate this in terms of percentages. So you can take that number and then divide it by the previous, and now you've got negative 4.72. So that is the level of backwardation that we're seeing between M1, which is going to be this right here, because it's the first futures contract, and M2, which is going to be the normal regular VIX over here. So those are the two contracts that we account for to better understand short to medium term volatility. And the interesting thing is that if I bring over this chart now, which was the courtesy of VTS, essentially providing us with a lot of research and a wealth of information in volatility, this right here, what it shows us is the long term averages and the values for contango versus backwardation between M1 and M2 VIX futures. So what we have here is, as you can see, the M1 and the M2 VIX futures and the difference between those two numbers. And the long-term average, as you'll notice, that majority of the times the markets are in contango because markets are actually moving higher. We know that S&P 500, for the most part, we've got a 72% probability that it actually goes up, right? It is moving in a nice, stable, healthy environment where it's actually making higher highs and higher lows, and it's moving higher. So that as a result, volatility futures are also in contango, meaning that they are in a very stable environment. The next month's futures are priced higher than the current month's futures, so on and so forth, and it's actually moving in a nice stable environment. So the rolling percentage of days positive, 83.78%. So this is showing us the difference between M1 and M2 VIX futures. And if you come over to my spreadsheet, it's essentially giving us a plotting of this number right here, this 4.72%, the number that I just calculated, which is the current reading of backwardation. That chart is showing us the historical calculations and the value of the front two futures contracts on volatility and how it's actually traded. So what you'll notice is the majority of the times this number is positive, and it should be because markets are in normal, healthy, stable upward trajectory and we are in contango. But the few times if we actually dip below the 0% mark, we move into backwardation. That's where the markets have elevated risk. That's where there's short-term volatility priced higher than long-term volatility. And as a result, we see such incredible spikes in volatility, so to speak, and the markets, of course, come down because of that negative correlation as well. Because of that inverse correlation, although it doesn't need to be because the volatility in general are directionless, but because of that negative correlation, as volatility spikes, markets come down and we move into backwardation. So our goal, our job, our simple idea in markets, and this is one of the indicators that I use out of many, is to understand when we go from contango to backwardation, because historically the first sign of backwardation, when the first two contracts flip, M1 is priced higher than M2, that is a bearish signal, meaning the markets are now starting to price in more short-term volatility compared to long-term volatility, and that is a bearish signal. Believe it or not, every time in the past when we have seen a switch from contango to backwardation, that's been a true sign to actually move into safety from a more tactical perspective. As you guys know, that we are buy and hold investors here at MoneyVest. We mostly focus on long-term opportunity, but it is just one of those things that it helps you kind of prepare, raise more cash, raise more capital for better and better buying opportunities as they are presented in the markets as they continue to sell off. Now, our goal right now, since we are in backwardation, as of the time of this video, we are in a moment of backwardation where M2 is priced lower than M1. So short-term futures contract is priced higher than long-term 30 days out. We are in backwardation. So our goal is to better understand when are we going to move back into contango. And that should not take long because historically, as I said, there is a rolling positive number of 83.78%, meaning 16% of the times only in the history of this index, which we have created going back as far as 2004, we're talking 20 years, it's been only 16% of the times the number has dipped below zero. Only 16% of the times. 83% of the times there has been contango, meaning M1 is priced lower than M2, M2 is higher than M1, and as a result, the markets are in a healthy uptrend. So it should not take long, and we have to keep a close eye on how this VIX terms structure changes, and you'll notice that we are again getting closer. We're starting to flatline a little bit. Once we flatline, and once this short-term volatility 9-day futures dips below that volatility of 30 days, that's when we're going to be in contango, and now the markets are starting to once again restabilize. Selling pressure is going to start exhausting itself out, and we're going to see some type of healthy upward reversal from the markets. So that's just one of the many ways in terms of using volatility to better understand the current market structure, the current sell-off that we're witnessing. How low can we possibly go? Obviously, nobody knows, but technical analysis on top of that, and then you layer in the MoneyVest index and other market breadth indicators to better understand where the risk reward is going to be optimal. So this is exactly the whole idea of using volatility in better understanding short-term versus long-term futures and whether we are in contango or backwardation or not. So hope you enjoyed this video. We're going to be, again, keeping a close eye on this particular ratio over here, still in backwardation of negative 4.72. But as soon as we turn positive and we are in contango again, there can be a potential sign for the markets to stabilize a little bit, and there can be a bit of a healthy correction, healthy reversal, once again into the markets here. SPY right now, so we are seeing some pre-market stabilization, so 4 basis points higher. QQQs right now at the moment are also 15 basis point higher, so we'll continue to monitor this market sell-off. We are still in a bit of a correction on the NASDAQ, and of course SPY here is still down a little bit over 8% from its all-time highs. So keep you guys updated on our Discord if you want to join. Link's gonna be down below with that 16% annual discount, and as always, happy investing. I'll see you all in the next video.